Colin McLean, founder and managing director of SVM Asset Management, joins us from Edinburgh to explain why, Colin, you don't think the markets are going to really be reassured or encouraged by the outcome of this meeting.
Good morning. I think the lack of French and German agreement is still worrying the markets, and I don't think they will agree on a big enough fund, as well as the signs that we have that perhaps they're focusing on a rather lower level of recapitalisation for the banks than the IMF has suggested. So I don't think the market's going to be comforted by those figures. It's just not enough money and possibly not coming in quickly enough.
We were hearing that there would be a capital shortfall of €2 billion. That was the figure that we were all focusing on when it came to bank recapitalisation. Now we're hearing about something in the tune of 100 to possibly even 80 billion to emerge from this meeting. But how much is enough? Because even 2 billion at one point, there were those saying, well, there just isn't enough clarity to know that this would do the job.
Yes, I would think a much larger figure is needed, because it's not really stress tested for the softening we're seeing in particularly the German and French economies just now are softening very quickly indeed. And so I think the possibility of much slower growth in Europe, also in the UK and Ireland as well, here I think all of those will put different stresses on the banks and I think require bigger recapitalisation, which I think the governments are going to have to stand behind. I don't know where the money is going to come from, but I think we will need a bigger level. And as with the stress tests recently in July, they just didn't really test really quite enough.
So what would give you more confidence when it came to investment, or at least when you look at the state of the banks right now? Would you like to see some sort of recapitalisation, some sort of coordinated effort on a regional European level, or do you think that it's more realistic for individual governments to take care of their own banks?
I think the latter, really. I think individual governments are going to have to focus on what they want to back as a national champion and either explicitly put money in or make it quite clear the guarantee stands behind the banks. But I don't see investor or public money readily coming in for this, so I think we'll see a quasi-nationalisation of some of these banks, and that will then comfort investors and perhaps reassure the interbank lending market, the wholesale market. So I think it is going to demand a lot of individual government support, and it's probably best done at that level than trying to coordinate things, because the challenges for each country are a little bit different.
You know, Colin, I just want to get into the specifics of your investment strategy now, and I know that you've been bearish on financials with results from Wall Street's big banks disappointing. I know that you've been cutting back on mining exposure, but you're still holding gold and oil companies. Relatively bullish positions you've got on tobacco, utilities and pharma stocks. So just take me through your reasoning behind this strategy.
Well, we're certainly focusing on more liquid areas. I think with volumes being lower in the market, I think we need the flexibility in the portfolios to be able to adjust. I'm certainly concerned about the recent weakness we've seen in copper, and I think we may have seen the best of the performance from the major diversified and base metal oriented miners in the short term. But I think if we are going to get more quantitative easing, stimulation, then I think there's prospects perhaps for oil, gold to stay up. So we're a little bit more comforted there. But most of our orientation has been moving into more defensive areas.
I mean, just picking up on what you were saying, how concerned are you about the direction of the price of copper right now? Because we are seeing, well, we have been seeing commodities, and then commodities-based companies, many mining stocks, actually falling because of concern that there will be a slowdown in demand, well, not just in developed economies, but of course in China as well. Is that something that is in the back of your mind when you're looking at these companies?
Yes, indeed. I think I expect Chinese growth to slow further. I think it will slow, and it will be against a background of some trade frictions and talk about protectionism from the US. So I think that will be a concern. The Chinese are not buying more now. There's some inventory picking up. And copper is often a lead indicator. It was in the market rally coming into 2009. And I think the breakdown in copper price more recently, I think, is worrying for the market overall. And
talking specific stocks, Colin, I know that you've just added AB Foods and Tate & Lyle to your portfolio. Why?
Well, the sort of more defensive stocks we like. There are stocks, and both of those are still getting earnings upgrades. So and they have a predominance of slightly negative opinion by analysts as well. So we saw that with a stock like Nokia yesterday. Sometimes stocks don't have to do too much if they have enough of a negative perception already to confound short sellers and confound analysts. And Tate & Lyle's got a high proportion of dollar earnings. It's seeing some upgrades, and AB Foods is off its recent peaks, and I think offers a little bit more cyclicity, but it's got some defensiveness.
All right, thanks very much. Colin McLean, founder and managing director of SVM Asset Management. Thanks very much.
Thank you.